Welcome back to the deep dive. If you are listening to this, you are part of a global, multi-trillion-dollar system of fiscal policy that few people, really few people, ever pause to actually look at. We are talking about that mandatory line item on your pay stub, that crucial element of international business, that mechanism that makes modern governments run, tax withholding.
It truly is the ultimate financial shortcut for the state, isn't it? It's a mechanism that, almost every working adult on the planet interacts with, yet it just hides in plain sight.
Right.
Whether you know it as tax retention, pay as you earn, or tax deduction at source, its function is, well, identical across borders. For something so universal, its mechanics remain surprisingly opaque, mostly because you, the recipient, never really have to deal with the gross amount.
And our mission today is to pull back that curtain. We are diving into the mechanics, the goals, and the global variations of tax withholding using the detailed source material you provided as our exclusive guide. We want to understand not just what gets withheld, but why the system is structured this way and why it's so powerful.
And the fundamental concept here, and this is really crucial for you to grasp, is that this is income tax paid to the government, not by the recipient of the income, so not the employee or the investor, but by the payer of that income.
The employer.
Usually employer, yeah, or a financial institution or some other business entity.
Yeah.
The tax is deducted or withheld from the income before the recipient ever sees the full amount they earned.
Okay, let's unpack this. Why do governments bother with this system? Logically, wouldn't it be simpler to just calculate the entire bill once a year and send an invoice? Why invent all this complex machinery?
The source material is very clear on the core justification, and it's all centered around risk mitigation and, frankly, political stability. Withholding serves two monumental purposes. First, it is a hugely effective tool for combating tax evasion.
Okay.
If the money is collected at the source, the transaction is immediately documented and the revenue is secured. It never enters the hands of the individual who might later decide not to report it or might conveniently forget about that specific income stream.
So it's the government inserting its hand into the stream of money at the earliest possible point?
Exactly. It minimizes the opportunity for non-compliance simply by removing the funds immediately. Second, and perhaps even more stabilizing for national treasuries, it ensures that taxes are paid on time. Governments in virtually every major jurisdiction have written laws that require taxes to be paid before the money can be spent on anything else.
And this solves the problem of taxpayer default. Because if I get a large tax bill at the end of the year, I might not have the cash set aside, especially if I've spent it already.
Precisely. By timing the collection to coincide directly with the payment of income, the government completely mitigates the risk of taxpayer default when the tax bill falls due in arrears.
I could see that.
Imagine a country where all citizens had to save up 20 or 30% of their income all year long and then write a massive check in April. The default rate would be astronomical. It would lead to massive instability in government funding.
It'd be chaos.
Total chaos. Withholding secures the government's revenue stream instantly, providing predictable cash flow for public services. That stability is the unheralded genius of the system.
That makes perfect sense. It's an administrative solution to a human behavioral problem. We tend to spend what we see.
Absolutely. The government essentially forces compliance by acting as the recipient of the first slice of every financial payment made in the economy.
That structural necessity brings us to our first major distinction in the mechanics. We need to clarify the difference between the two main types of withholding, because this dictates whether you, the listener, get a refund at the end of the year or if your tax obligation is just settled.
Right. It's the difference between a provisional down payment and a final receipt.
So what's the first type?
This distinction truly defines how you interact with the tax system. Most people encounter the system as a prepayment, or what is formally known as a payment on account. This is the typical method used for, employment wages in places like the United States and in most tax scenarios worldwide.
Okay, so prepayment. What does that mean mechanically? If my employer withholds $500 this week, how does the government treat that money?
That $500 is treated as a partial payment toward your final annual tax liability. And crucially, that final liability is a moving target. It isn't calculated until the end of the year when you file your comprehensive tax return. The withholding throughout the year is just an estimate designed to get you close to zero.
I see. So the implication is that filing a tax return is absolutely required to reconcile everything. That's why we get a W-2 or a T-4 form It confirms how much was prepaid.
Exactly.
And this is also why we sometimes end up owing more or getting a refund if the employer withheld too much.
That's exactly right. The system makes an estimate of your annual liability based on your wages and the information you provide about your deductions and credits. But life intervenes. You might have received a large bonus, or gotten married, had a child, changed jobs.
Or the tax code itself changed halfway through the year.
Right. Since the withholding estimate is based on static information and annualized projections, is almost never exactly right. So that reconciliation process via the tax return is mandatory under the prepayment model.
Okay, so contrast that with the other major type, final withholding. This sounds much simpler.
It is much simpler, but only for the specific income stream involved. In cases of final withholding, the tax is deducted entirely discharges the recipient's tax liability for that particular income. The government essentially says, we took our share now and we are done with this specific amount of money.
So no year-end reconciliation for that income?
The implication is that generally no additional tax return or additional tax is required for that specific income. It's a clean break.
Why would a government use a final withholding rate instead of demanding a prepayment? What's the logic there?
It's typically used for income, where compliance or collection certainty is paramount, or where the administrative difficulty of getting a return later would be high.
Like what?
Well, examples include certain investment income, like dividends or interest, or, most commonly, for payments made to non-residents. If you're paying a non-resident in another country, the chances of making them file a complex tax return in your jurisdiction later are very, very low. Final withholding ensures the tax is collected immediately.
So the government has essentially made a pact. We take this fixed amount now, and we promise not to ask for more later on this specific dollar amount, making it administratively simple for both sides.
That is the practical and legal effect. Now, we also have to look at how these amounts are calculated, which again splits based on the income type. For payments other than employment income, like those investment payments we just mentioned, interest, dividends, that sort of thing, the amount withheld is typically a fixed percentage.
That seems straightforward. A flat rate applies to that whole category of payment.
Yes. For example, a country might impose a 20% final withholding tax on royalty payments paid to a non-resident. It's a clean, simple, and predictable calculation.
But employee income is structurally different, right? Because an employee's tax situation is so dynamic.
Absolutely. For employment income, the amount withheld is almost always based on an estimate of the employee's final annual tax liability. And this estimation process is fascinating because it requires collaboration. The estimate is determined either by the employee themselves, through the representations they make to the employer.
Like declaring your filing status and dependents.
Right, exactly. Or it's determined by the government, which publishes these highly detailed withholding tables for the employer to follow.
What's fascinating here is how this seemingly simple system fundamentally shifts the responsibility and the timing of tax payment. It moves the burden of collection from millions of individual taxpayers to a much more manageable number of institutions.
That is the core administrative genius we alluded to earlier. I mean, think of the logistical cost savings. Instead of the tax authority having to chase down 10 million individual taxpayers every month, they only need to monitor, audit, and collect remittances from a few 100,000 large entities.
The employers, the banks, the big businesses.
Exactly. It minimizes collection costs, it maximizes the assurance of timely payment, and it provides the Treasury with a continuous, reliable stream of revenue. It's an incredibly powerful lever of fiscal control.
Okay, moving now to where most of us actually encounter this system. Wage withholding. This is the bedrock of income tax collection globally. It's often called payroll tax, though that can be a bit of a broader term.
Indeed. It's the standard operating procedure in nearly all industrialized nations. But our source material highlights a significant layer of complexity that immediately arises in federal systems. Multiple government levels.
Right, like in the U.S. and Canada?
Exactly. In the U.S. and Canada, withholding doesn't just happen once. It often occurs at the national or federal level, the subnational, so state or provincial level, and sometimes even at the local or municipal level for income taxes.
That layering can make a single paycheck calculation incredibly complicated. You might have 3 different tax jurisdictions, all demanding a slice, calculated using 3 different rule sets, even before you factor in the personal variables of the employee.
And the employer is responsible for all of it. The employer acts as this single funnel collecting for all 3 levels of government and applying those collected amounts as a prepayment on the employee's account.
with the understanding that it all gets reconciled at the end of the year.
Right, when the employee files their annual return with each of those jurisdictions.
And the employee has a critical responsibility here, making a representation to the employer to guide that estimation.
Yes, that representation concerns the personal and financial factors that influence the final tax liability. Essentially, you're telling the employer how much to hold back to get close to the target. This is achieved through forms like the U.S. IRS Form W-4.
Which allows you to adjust the estimate based on your expected deductions, credits, and other income you might have.
Exactly. The W-4 is essentially a forecast based on your circumstances today, and the employer must use this forecast in conjunction with government-published guidelines. Government bodies like the IRS or the Canada Revenue Agency publish these highly specific and quite complex withholding tables and algorithms for employers. The employer has to be meticulous, because if they fail to withhold the correct amount, they can be held liable.
Let's shift our gaze globally and look at how this standard is applied elsewhere, because not every country approaches wage withholding as just a prepayment system. The UK's approach is quite distinct.
Yes, the UK operates a system known as pay as you earn, or PAYE. And while they don't commonly use the term withholding tax, that is precisely what it is. The key fundamental difference from the U.S. model is that the PAYE system is designed to be cumulative.
Cumulative, what does that mean in practice?
It looks at the employee's total income earned so far this year, subtracts the allowances available so far this year, and calculates the tax due to date.
So it's not just a weekly estimate. It's a running cumulative calculation designed to true up the tax liability throughout the year.
Correct. The system generally aims to collect all of an employee's estimated annual tax liability through that continuous withholding process. If your income goes up or down, or your tax code changes, the employer adjusts the withholding in the next pay cycle to catch up, aiming for a zero balance at the end of the fiscal year.
So, for the vast majority of standard workers, the person with one job, no unusual investments, standard deductions, the end-of-year tax return becomes redundant.
That is the intended and realized efficiency of the PAYE model. For those individuals, the tax system is closed and reconciled every single pay period. It minimizes the annual administrative burden on millions of taxpayers.
Which frees up government resources.
Exactly. Resources that would otherwise be spent processing simple tax returns. However, the source material notes a crucial nuance. Taxpayers with more complicated affairs, maybe multiple income streams, self-employment income, they are still required to file returns. The PAYE system only handles standard employment income that efficiently.
That is a stark contrast to a prepayment system where the reconciliation process is virtually mandatory for everyone.
It speaks to different administrative philosophies. One favors immediate total collection and relies on the payer, the employer, to be extremely accurate. The other favors maximum simplicity for the payer, accepting the need for mandatory universal annual reconciliation by the employee.
And Australia has a system that sounds structurally similar to the UK model, but simplified.
That's the pay-as-you-go, or PAYG, system in Australia. It shares the operational goals, the UK model, aiming for accuracy throughout the year. But the defining feature here is the governmental structure. The system applies only at the federal level.
Because individual states in Australia do not collect income taxes.
Correct.
That is a massive simplification for the Australian employer. They don't have to juggle state and federal rules, forms, and remittance schedules.
Absolutely. It removes one of the most significant layers of complexity we see in federations like the U.S. or Canada, streamlining the whole calculation. The efficiency of Australia's PAYG system is rooted not just in the withholding method, but in the constitutional structure that limits the layers of income taxation. For an employer, it's a huge reduction in compliance cost.
Okay, here's where it gets really interesting for me. Withholding is not just a mechanism for salaries. We started this dive saying it's a crucial element of fiscal engineering, and that's because many sophisticated tax systems require taxes to be withheld from payments between domestic persons or entities that are not traditional employment relationships.
This is where governments flex their muscles to ensure compliance across the broader financial ecosystem. They realize that wages are trackable, but investment income or payments for services are far less visible.
Yeah.
We see this mechanism applied extensively to investment income, specifically interest and dividends.
Can you give us some domestic examples of how this forces compliance on financial flows?
Sure. Ireland, for instance, requires tax withholding on interest paid on deposits by banks and building societies to individuals. It's known there as the deposit interest retention tax. The bank, which is the entity with the deep administrative capacity, is required to withhold this tax before the interest ever hits your account.
So the government gets its share immediately. And the U.S. has a fascinating specific rule called backup withholding, which sounds less like a standard tax collection method and more like, well, like an enforcement tool.
That is precisely what it is. U.S. law mandates backup withholding on dividends, interest, and other reportable payments in very specific circumstances. It's designed purely to enforce administrative compliance and documentation.
What triggers this backup mechanism?
There are a few triggers. The most common is if the payee fails to provide a valid tax identification number, a Social Security number, or employer ID to the payer. If the payer doesn't have a number, they can't report the income properly to the IRS. So the government forces immediate collection at a specified rate.
So it's a targeted penalty for administrative failure. If you fail to give the payer your essential ID, the payer is required to hold back a chunk of money immediately, ensuring the government gets some revenue even if they can't accurately track you later.
Exactly. Another trigger is when the IRS has specifically notified the payee that backup withholding is now required due to past failures. Perhaps they underreported interest income in prior years. The paying entity is then obligated to start withholding at that backup rate until the recipient resolves their issue with the IRS.
It turns the payer into a frontline compliance officer.
It really does.
It's interesting to note that the UK seems to have moved away from this on interest and dividends recently.
They did. The UK discontinued withholding tax on most domestic interest and dividends after April 2016. However, that income is still absolutely taxable. The burden of administration simply shifted. They introduced things like the personal savings allowance and the dividend allowance, which shifted the responsibility back to the individual taxpayer to report and reconcile that income stream.
Which demonstrates that tax policy is always this balance between collection certainty and administrative efficiency.
Absolutely. The costs imposed on financial institutions are always part of that calculation.
Now, let's talk about a far deeper form of government control: business-to-business withholding. This is a level of scrutiny that extends the definition of payer as collector deep into the commercial sector.
This is a critical compliance tool, particularly in countries where tax evasion in the non-wage sector is historically higher. A prime example is India, which operates the extensive tax deducted at source, or TDS system. This system enforces withholding tax not just from companies to individuals, but often on payments between companies for services, rent, commission, all sorts of things.
That sounds like an administrative challenge of colossal scale. If Company A pays Company B for consulting services, Company A has to calculate, withhold, and remit a portion of that payment to the government, acting as a tax collector for Company B.
That's precisely the process. It creates this massive cross-referenced paper trail. The benefit for the tax authority is that if one business fails to report income, the corresponding withholding certificate filed by the paying business provides irrefutable evidence of the transaction.
So it's a self-auditing compliance network.
In a way, yes. The administrative costs are significant, of course. It requires robust accounting systems to track not just payments, but the required TDS rate for dozens of different categories. The compliance burden shifts significantly from the government to the private sector.
We see a similar, though perhaps simpler mechanism in Australia regarding business identification.
Correct. In Australia, withholding is required when the payee, whether they are an individual or a business, fails to provide a tax file number or an Australian business number. Again, failure to provide basic identification triggers the withholding mechanism. It's a default compliance setting.
And then there's the fascinating preventative approach in Rwanda, which places the burden of proof for the recipient's compliance squarely on the payer.
The Rwandan system is incredibly robust. Rwanda charges withholding tax on business payments unless the paying company obtains proof that the recipient is properly registered with the tax administration and has a recent income tax declaration.
So imagine being a paying business in Rwanda. You are essentially forced to become a mini tax compliance officer for all your vendors. If you don't collect their proof of compliance, you have to withhold tax from them.
That's exactly the mechanism. It creates a massive incentive for every business to ensure that every other business they deal with is fully registered and current on their taxes. It's a very smart way to ensure universal registration within the business community.
So if we connect this to the bigger picture, domestic withholding on non-wage income demonstrates the government's desire to capture income streams that might be easier to hide or misreport.
That's the summary. Wages are regular, predictable, and easy to track. Investment income and service payments can be erratic, sometimes involve complex contracts, or easily cross regional lines. By placing the obligation on the sophisticated institution, the government ensures these flows are documented and taxed the very moment they occur.
Okay, we've spent considerable time on the domestic side, but now we jump into the international realm where the term withholding tax is perhaps most specifically and commonly used. Here, it acts as a crucial lever in cross-border payments.
This is the domain of the non-resident rule, which is the cornerstone of international withholding policy globally. The general principle is that most countries require withholding when payments are made to non-resident payees. The payer typically identifies them as non-resident simply if a non-domestic postal address is in their financial records.
Why do countries universally insist on this non-resident withholding?
It's a question of jurisdictional sovereignty and control. A country has the right to tax income generated within its borders. Passive income, like interest or dividends, is highly mobile. Once the cash leaves the country, the taxing authority loses all leverage. International withholding ensures that the country where the value originated, the source country, secures its tax share before the money physically leaves its borders.
What types of payments are typically subject to this?
Most commonly, passive income streams, interest, dividends, and royalties. The standard withholding rates on these can be quite high, often 25% or 30%.
And there are some interesting nuances regarding payments for professional services or rent.
Yes, our source notes that some jurisdictions treat fees paid for technical consulting services as royalties, which then subjects them to immediate withholding tax. This can be contentious because the source country views the technical knowledge as a licensed asset, whereas the paying company just views it as a business expense.
And rental income. If a foreigner owns an apartment in my country and collects rent, how is that handled?
The rules vary. For example, U.S. tax rules say if the foreign rental activity rises to the level of an actual trade or business meaning active management, the income is usually taxed as business income. But if the rental is just passive investment income, it may be subject to a fixed, substantial withholding tax, often 30%.
That sounds like a recipe for the worst outcome, double taxation. The source country withholds 30%, and then the recipient's home country also wants to tax that same income.
That is the exact problem that necessitated the development of sophisticated income tax treaties. These treaties are formal, bilateral agreements between two countries. Their primary function in this context is to reduce or eliminate double taxation by lowering the standard withholding tax rate for particular types of income.
So if I'm a resident of country A receiving a dividend from country B might normally withhold 30%, but if a treaty exists, that rate might be reduced to, say, 10%.
Precisely. These are usually reciprocal agreements. But utilizing those lower rates isn't automatic. The procedures for obtaining them vary greatly, often requiring the payee to file specific forms or certifications with the payer before the payment is made.
And if too much is withheld, say the payer accidentally applied the standard rate instead of the treaty rate, is there any way to get that money back?
Yes, but it requires administrative effort. The recovery of that excess amount is usually made by filing a specific, non-resident tax return in the foreign country. This process can be time-consuming, and countries often impose strict time limits.
And even if you can't recover the excess tax immediately, the payee gets a crucial benefit back home, the foreign tax credit.
It truly is the mechanism that makes international investing viable. The foreign tax credit ensures that the tax withheld in a foreign country may be eligible for a credit in the payee's home country. Without this credit, every cross-border investment would effectively be double taxed, which would choke global capital flows.
Walk us through how that actually works, because it's not a simple one-to-one deduction.
It's not. The credit is usually designed to ensure you only pay the higher of the two tax rates, your home country's rate or the foreign country's treaty rate. The crucial element is the limitation. Your home country will typically cap the credit at the rate you would have paid at home on that same income.
Can you give us a quick example?
Sure. If you earn $100 in dividends and the foreign country withholds $15, a 15% treaty rate, but your home country's domestic tax rate is only 10%, or $10, your foreign tax credit is limited to $10.
So you don't get the extra $5 back from your home country.
No. Conversely, if your home country rate is 40%, you get a $15 credit, and then you pay the remaining $25 to your home country. It ensures you're only taxed once overall, but at the highest relevant rate.
It's complex but essential for trade. Let's look at how large economic blocs like the European Union try to simplify this complex web of treaties among their own members.
The EU attempts harmonization via specific directives. For example, the Parent-Subsidiary Directive generally prohibits taxation by one member state of dividends paid from a subsidiary in another member state, with some exceptions. Similarly, the Interest and Royalties Directive eliminates withholding tax on interest and royalties paid between associated companies of different member states.
The goal is to make the single market as seamless as possible.
Exactly, to facilitate free capital movement.
This raises an important question. What about selling real estate? Real property is the definition of immobile. You can't move it. But the profit from its sale, the capital gain, is highly mobile. A non-resident seller could easily leave the jurisdiction with their capital gains before the tax collector even knows.
This is where withholding becomes arguably the most powerful and targeted collection tool available, securing capital gains on real property sales by non-residents. The source highlights two major examples, the U.S. and Canada.
Let's start with the U.S. FTTA rules.
The Foreign Investment in Real Property Tax Act, or FEPTA. It imposes a significant 15% withholding tax on the amount realized from the sale of a U.S. real property interest by a foreign person. The ingenious part is that the purchaser, the buyer of the property, is required to withhold this amount and remit it to the IRS.
Wait, the buyer's the tax collector. Why put that burden on the buyer?
Because the seller might be on a plane the moment the closing documents are signed. The buyer is the party physically present and within the jurisdiction holding the cash. The mechanism ensures that the 15% is secured and delivered to the IRS before the foreign seller walks away with their profit.
Can you avoid that 15%?
The only way is if advance IRS approval is granted, using Form 8288B for a lower rate based on a pre-calculated actual capital gains liability.
And Canada operates similarly, but with even higher starting rates.
Canada imposes similar rules. The mandatory withholding on the proceeds starts at 25% and rises to 50% for the sale of business real property. While these amounts can be reduced upon application, the initial mandatory withholding is high to ensure the tax authority is fully protected against the flight risk of the seller.
The summary here is clear. The withholding mechanism ensures the seller pays their capital gains tax obligation before they leave the jurisdiction with the proceeds.
It transforms a potential liability into an immediate collected payment, protecting the source country's tax base.
Shifting gears now, we need to address social insurance, or Social Security taxes. While technically distinct from income tax, they are collected using the exact same powerful, efficient withholding system.
Absolutely. They are structurally integral to the payroll withholding process. Many systems, like those in the U.S., Canada, and across Europe, require contributions from workers to fund future retirement annuities, medical coverage, and unemployment benefits.
And these systems impose a dual responsibility, making the employer pay twice, essentially.
They do. It's a cost shared between the two parties. Both employers and employees must contribute. The employee's portion, the deduction we see on our paychecks, is withheld from wages and remitted by the employer. And crucially, the employer also has their own matching or separate portion they must pay.
And this is all codified in law.
It is. For example, U.S. law distinguishes clearly between the employee portion and the employer's separate matching portion. The rates themselves are set by law and may differ, though they are fundamentally tied to the same income base.
A key complexity of social insurance taxes, unlike standard income tax in many systems, is the use of wage limits and caps.
This is a fundamental design feature linked to the concept that social insurance benefits, like a retirement annuity, are themselves capped. Most systems, therefore, impose an upper limit on the amount of wages subject to these specific taxes. Once your income crosses that threshold, you stop paying that specific tax, at least for the rest of the year.
Can you walk us through that cap mechanism using the figures in the source material?
Let's use the 2009 U.S. figures as an illustration. That year, the retirement portion of Social Security tax had a wage limit of $106,800. The employee paid 6.2% up to that amount. However, the Medicare portion, which funds medical coverage, had a rate of 1.45% and no limit.
So once an employee's salary crossed that $106,000 threshold, the employer stopped withholding the 6.2% retirement portion, but continued withholding the 1.45% Medicare portion indefinitely on all wages earned above that cap.
Precisely. The cap ensures that the employee doesn't overcontribute to a retirement system where the eventual benefit is capped anyway. We see similar structures globally. The Canadian Pension Plan, for example, for 2009, had limits where the tax was only applied to a specific range of income wages over a basic exemption amount up to a maximum contributory earnings amount.
And these caps are always being adjusted.
Constantly adjusted, but the fundamental principle of a cap remains.
The entire effectiveness of the withholding system for both income tax and social insurance is completely reliant on the speed of the collection. That brings us to the remittance requirements. How fast does that collected money need to get to the government?
The urgency is extreme. Tax authorities worldwide do not view this money as belonging to the employer, even for a day. It is legally the property of the state. Withheld taxes must be remitted within specified time limits, and these limits vary sharply depending on the volume of money withheld.
Give us a sense of that administrative speed.
The U.S. system is very demanding for large remitters. If the unremitted balance exceeds $100,000, the U.S. requires electronic remittance no later than the following business day.
The next day.
The next business day. That's almost instant remittance. Canada uses quarter-monthly periods for high-threshold remitters, requiring remittance within 3 business days. These strict schedules demonstrate that the primary goal of the system is maximum velocity of collection.
That puts an enormous administrative strain on large employers. They have to run payroll, calculate thousands of different withholdings, and transmit that money to the government within 24 hours.
It demands sophisticated, instantaneous accounting systems. But the consequences of failure are designed to be a stronger motivator than any administrative cost.
The penalties must be equally severe.
They are designed to be terrifyingly severe. Penalties for delay or failure to remit can be heavy interest charges and late fees. But the most important and punitive mechanism is reserved for intentional failure. In the U.S., penalties of up to 100% may be assessed for intentional failure to withhold and remit.
Wait, 100% penalty? That seems draconian. Why is the government so much more aggressive with this money, which is technically the employee's money held in trust, than with standard unpaid income tax?
Because the law treats those withheld funds as a trust fund. The employer is merely a custodian holding the funds on behalf of the government and the employee. When the employer fails to remit this money, they are effectively misappropriating funds held in trust. The government views this as far more serious than a simple debt.
And who exactly is liable for that enormous penalty? Is it just the company?
This is the critical enforcement element. The penalty can be assessed not just against the company, which might be insolvent, but against any person, including corporate officers, managers, or employees who had custody or control of the funds and willfully failed to remit them.
So it pierces the corporate veil.
It's designed to. It's known as the trust fund recovery penalty, and it is a powerful legal mechanism to ensure that those in charge of a business prioritize the tax obligations over, say, paying suppliers or covering operating costs.
So the tax liability follows the person responsible for signing the checks, ensuring they face personal financial ruin if they misuse the government's money.
Exactly. It solidifies the absolute priority of the government's claim to those withheld funds.
And legally, what happens if the business goes bankrupt?
Well, sums withheld are regarded as a debt to the tax authority. While generally, the tax authority stands as an unsecured creditor in bankruptcy, because of the critical importance of these funds, many jurisdictions grant the tax authority legislative priority over other creditors for unremitted withheld taxes.
Which again reinforces that this is not business money, it is government money.
Absolutely.
Finally, the entire system relies on a detailed reporting requirement, the paper trail that connects the money taken by the employer to the liability of the employee so the final reconciliation can occur.
Yes, the transparency and accuracy of the system depend on this. Nearly all systems require detailed reporting of the withheld amounts both to the person on whom the tax is imposed and to the government. We know these reports as U.S. Forms W-2, Forms 1042, or in Canada, Forms T4 and NR4. This documentation is the crucial link that allows the final reconciliation we discussed in Section 1 to proceed smoothly.
What an incredible mechanism of fiscal control and administrative efficiency. We've covered a lot of ground today, reviewing the key takeaways. Withholding is a highly effective, government-mandated payment shortcut used not just for wages, but for investments, service payments, and critical cross-border transactions. It is expertly designed for maximum speed and absolute assurance.
And what's fascinating here is how a concept that seems purely administrative, the timely removal of funds, is simultaneously a powerful tool for social policy, funding massive retirement and medical care programs, and a critical instrument of international diplomacy, facilitated and mediated by tax treaties. It's the invisible, high-velocity infrastructure of global finance,
Guaranteeing the state's survival.
At the end of the day, yes.
That structural efficiency is remarkable. And it leads us to our final thought for you to mull over. The source material mentions that governments sometimes impose additional tax withholding requirements if a recipient has been delinquent in filing tax returns or works in industries where tax evasion is perceived to be common, like certain contract or gig work.
Right. So consider the ethical and administrative complexities of using tax withholding not merely as a neutral standardized collection tool, but as a punitive or prophylactic measure targeted at specific groups or industries based on perceived compliance risk.
So when does a standardized tax shortcut cross over into being an instrument of targeted enforcement designed to manage the behavior of specific populations? It's a powerful question about the limits of state power in modern fiscal governance.
This really is.
Something to ponder the next time you look at that deduction line on your paycheck. Thanks for diving up with us.